Welcome to today's Corporate Venturing Insider series. I'm so excited today to have Sriram with us. Sriram, welcome.
Thank you so much for having me.
So it's been a while we wanted to talk and be having you on the podcast. Let's start with your background. How did you get into corporate venturing and now venture capital?
Yeah, so I spent my early days, 20 years of my career actually at Intel. So this was the time when Intel was really sort of the pioneering company in technology along with Microsoft. Intel really was building a platform, not just, building the core chip, but they were doing a lot of things. And Andy Grove, who was the CEO at that time, was very clear in his mind that, Intel actually has a lot more than just core technology or architecture. His view was that Intel succeeds when the ecosystem in which Intel plays in is successful, and people around that ecosystem were writing software and building products and other chips around that platform of Intel architecture. And to actually drive that, he had this belief that you really have to have a healthy ecosystem, and one of the ways to have a healthy ecosystem is to invest in that ecosystem. And coming out of that, came a function called corporate business development within Intel. And that was entrusted with the objective of, investing early stage companies and such. So I was very much part of that. I was in my first job, I was a technical marketing director supporting the executive office of Gordon Moore, Andy Grove, and Craig Barrett. And so I had many opportunities to sort of work very closely with them as they were just sort of thinking about all of this. There used to be a corporate VP, executive VP at Intel, Les Videz, who was employee number 3 at Intel. And so he had this function, corporate business development, and I was part of the original team as we were thinking through what Intel would do. And out of that came Intel Capital. So I was one of the early guys in Intel Capital. And prior to that, I was in software and networking and in consulting, actually. In the manufacturing industry. So it was a good transition for me to sort of be a technologist prior to Intel, looking at emerging technologies. And it was a perfect moment as Intel was actually exploding in the scene. And as they were trying to create this ecosystem, I had this unique opportunity to be part of it.
Very nice. I have to ask, because they are legends, do you have any anecdotes from Andy Grove, Les Valdez, which carries over to your investing career?
Yeah, well, there's so many things about Grove, Andy Grove, who is truly one of the iconic technologists of our time, of our generation. But more importantly, he's also an incredible manager. I mean, he could cut through the core of an issue, pretty sharp. I mean, it's like I haven't seen anybody else do it as incredibly as he was able to do it. And so maybe there's one small anecdote or a phrase that, of course, everybody knows paranoid, only the paranoid survive. It's a great book, and it's really right when you're at the top of the heap in any field or in any technology. And this sort of applies to not just companies, but even individuals. And you think that you're at the peak performance, when do you worry? Not when you're not at the peak performance, but you worry when you're at the peak performance. And that is so true of companies that get, complacent and don't innovate well. And there are so many examples in our industry, starting from Xerox to Nokia to Alcatel to AT&T and a variety of them. So that applies quite a lot. So the one phrase that Andy has used that sticks to me a lot is that he would say, before you pour concrete on strategies, let chaos reign. And then, if you really get it, reign in the chaos to your advantage. So it's sort of a play of words, and and he would use it a lot. Let chaos reign and reign in the chaos.
Yeah. Now, Intel Capital is one of these success stories. And I think it's interesting to understand that the starting point was an ecosystem play. It was going beyond just selling a chipset, selling a few components, but really looking at the full ecosystem. Can you speak to why that probably was the right starting point to make a CVC be very successful?
Well, Intel sort of looked at it in three ways. And I'll give you a simple sort of a analogy to make the point simpler. So it's sort of like, having a pizza. And the pizza has many slices. And each of those slices represent the different businesses a company is in. And the overall size of the pizza is the overall SOM, or SAM, the segment addressable market that you're playing into. So Intel had this analogy, which is we're in the business of doing three things. Number one, increase the share of the pie of the pizza in the markets that we're in. So increase market segment share, number one. Number two, increase the overall size of the pizza, which is overall available market that we can address. So that's the ecosystem point. Unless the ecosystem is successful and thriving and growing, you can grow. So that's the second point. And the third point was create new pizzas or new markets that you're not in. Maybe the markets are not even developed. So invest in creating new markets. So that analogy is very, very striking for most corporates. How does a corporate benefit from all the work that you end up through your corporate venturing activity if it doesn't improve one of these three things? It gives the company a unique advantage in the market that you're in. It helps the overall ecosystem grow, and it creates new paths or new markets for the corporate to get into. So that's sort of the justification for any company that has a corporate venture arm. If you cannot cater to these three things, then you're just a pure financial investor. You're adding to, your EPS and bringing, cash into your balance sheet. Nothing wrong in that, but one should not confuse that as being a strategic activity.
I love it. Intel Capital was very successful in doing two things really well, exploitation and exploration. One was to work with partners and potential customers, potential suppliers of Intel as an ecosystem to help Intel grow that pie. But also exploration, looking at things that Intel was not involved yet, but might in the future. Can you speak to this dual mandate in a way and why it made Intel Capital so successful?
Yeah, so before I answer the question, I should confess that I've been out of Intel for a long time. I left Intel in 2012, so it's almost 15 years since that time. A lot of things have changed, and Intel's position has changed, and so on. In fact, the current CEO, Lip-Bu Tan, who obviously is one of the founders of Celesta, along with Michael Marks and Nick Brathwaite and myself. So I have some exposure to the current Intel strategy. But that said, so Intel was actually going to completely change the rules of the game and launch something called, Centrino. And this was actually in 2003 when Intel was going to launch, it was called CMT, Centrino Mobile Technology. And it had three pieces. It had the core processor. It had the graphics, which was sort of an integrated graphics capability on chip or on a package. And then it had the wireless communication, which was Wi-Fi. For the first time, Wi-Fi was going to become native to the architecture of the mobile device. That was the first time people could even envision that you could have a mobile device which was light, compact, which was longer battery life, and you could actually connect wirelessly. And much before Starbucks and everybody else was there, that was the vision. So Intel said, well, how do I make it happen? I'm going to have these computers where they don't have anywhere to connect. So we launched the Wi-Fi fund for the first time. It was $150 million. And I ran that fund at that time. And the objective was to go enable the ecosystem to actually solve the problems that would prevent a mobile device from connecting. So things like, roaming and settlement and, single authentication, security, all of those things were required to be available in the market for Intel's core objective of having a device that could connect seamlessly, could become a reality. So Intel Capital did that.
Can you speak to your experience with WiMAX as a really good example in case where it was a superior technology and how it informs you as an investor today?
Yeah, I mean, it's a great case study of why falling in love with technology for for technology's sake, can be at your peril. And here is a disruptor coming into the market, namely Intel and the computing industry, saying that, guess what? We're going to tell you how wireless should be done when wireless has been invented and built and successfully grown by the telecom carriers. So there was a mismatch. And that mismatch was not just a mismatch between the technology and what the consumer wanted. It was a mismatch between what the technology promised and needed to make it successful and what the existing incumbents were prepared to do. This is why, as a corporate, when you're investing, you got to make sure that your investments do not piss off the people in the ecosystem whose support and success is integrally dependent, or at least connected, with the corporate. So Intel lost that. Intel lost that because the carriers said, we're not going to do WiMAX, because if we do that, we lose control. And so over the top, services come, and we become, as they used to call it, the dumb pipe. If I'm just a dumb pipe provider, virtually speaking, there's no physical pipe, but it's the virtual spectrum that the carriers are delivering, I'm getting commoditized. But this is the perfect example. There's a case study that a lot of people have written about, how not to lose the ecosystem. I mean, it's like, losing the forest for the trees, right? So Intel had the trees right, but it lost the forest.
I love it. That's a golden nugget. Now, if I think about how you invest today, that lesson, I'm sure, penetrates to everything you do.
Right.
How do you identify that go-to-market challenge, that ecosystem, that incumbents who may be an opportunity or a threat to that startup's mission?
I mean, this is a completely different role that I play. At Celesta, after leaving Intel, I had my own small fund called Indusage. My other co-founders, obviously Michael Marks and Nick Brathwaite, they had a firm called Riverwood. And of course, Lebu had a firm called Walden. And so Michael and Lebu originally put that deal together, and it was called WRV, Walden Riverwood Ventures. And Nick was part of that as well. And then I came in later and sort of merged my activity about Indusage, and we were called WRVI, which is what Celesta is. But to answer your question on how we think about it, each person has, their own flavor of, how you make investments in the areas of interest that you have an expertise in and all of that. But there are some core principles that I think apply to everything that we do at Celesta. We try to think of the core technology as a fundamental table stakes. There are great businesses in the market that may have minimal or limited technology or intellectual property. We don't go after those sorts of things as a first order, objective. We have made a lot of investments in the places where you can sort of think of it as higher up in the stack. You're not close to the metal, not close to the IP. We've made some of those. But our preference is to really look for what is the defensible technology or IP that can be scaled, and technology can be scaled. So that's sort of our first filter, if you will. Mm-hmm. And the second filter is, no technology. I mean, consistent with what I said about, Betamax and WiMAX and others, no technology by itself is going to be wildly successful unless you can figure out a use case, but perhaps more importantly, a financial and economic model that can actually pay for that use case with, rich margins. And if you cannot do those things, why invest in that? I mean, I might as well invest in real estate. I don't have expertise in real estate, great margins, but, what do I bring to the table? There's not something defensible. So I think we think of it in those three lenses. Core technology as IP, capability for, what is the use case or problem that you're trying to solve? And can you make, nonlinear growth of margins? And if you can do that, then you're in a great place. So
I want to double click on building that great syndicate. And I think what you're saying is basically a very strong, aligned why towards the mission of the startup. You have this beautiful venture point of having been in a corporate VC, now in a VC. How do you select, how do you decide which corporate VC is the right corporate VC at the right time for that given startup?
That's a very, very good question. Intel Capital did like 1,000 deals, and there are so many companies. So when you're that big, you have your hands on the pulse of so many things, and you have the sensors to know what's happening in the market. And there was a lull period where, post the dot-com bubble, when the corporate VCs went out of, vogue. And now they're back in, huge success and traction and all of that, thanks to, companies, creating incredible value for themselves, multiple trillions of dollars of market value created by some of these companies. So you have, NVIDIA and Microsoft and Google and others. So their platform has expanded. So naturally, and they're spitting out so much cash, so they can actually, for them, there's only so much cash that they can put into their own business to get the uplift on their margins. So they have to get other fast-growing areas. So corporate VC, this is the golden age for corporate VC, in my view.
No, I think it's a golden nugget. We're getting towards the end of the interview, but I want to ask you about the corridor of US-India. You have put this IDTA initiative, which is huge. I want to hear about why are you bullish about it, and do you think that deep tech in India is at the inflection point that I think you and I believe?
Yeah. Well, I mean, I want to make sure that it's the right question, but you have to, I don't want to sort of agree with some of the premise that you're implying, because I think India is a very complicated market. It's a huge market, and there's lots of appetite in India for building, entrepreneurial projects. In the old days, it used to be the large family houses, the Tatas and Birlas and Reliance and Bhartis and others, who actually were the ones that were making a lot of the investments. And in the last 20 years, you've seen lots of young entrepreneurs build very efficient business model innovation companies. And going back to my comment about sugar high, some of them had huge sugar highs because they made huge value appreciation. The market actually was attracting monies from the likes of SoftBank and Tiger and, a whole bunch of people. And that was a period, right? And then comes, starting to 2018, when people started sensing that this whole BPO, consumer internet, shared economy, enterprise software, services play that India was very good at may have its day of reckoning coming. And so the market sort of, warmed up to core technology, because everybody started asking the question, when you have, Google and Cisco and Qualcomm and all of these players that have tens of thousands of people in India working on hardcore technology problem, you still couldn't point to, one or two or three hardcore IP-based deep tech companies. Now, that said, the market has not solved a lot of the underlying problems in deep tech. I mean, you have very limited number of good, solid deals. I'm concerned that there is more capital available than the quality of deals that are there.
Okay.
That's not to say that that can't change over a period of time, but if you are not careful, you're going to have too many people putting too much money into few places. Supply demand, valuations are going to go up. So many of them are going to fail. So if you don't solve the underlying talent and technology and execution and management capabilities, just throwing money at the problem is not going to solve it. That's number one. Number two, you can't have just one or two people do this if you don't have a healthy ecosystem. And it goes back to my point about, co-investors and corporates and others. So this whole idea of IDTA came about as a result of the government asking a bunch of us, from the industry to support their objective of, providing an impetus to deep tech. and how the industry can help. And the industry said, well, instead of us just trying to do it one-off, let's try to have a coalition of the willing that are willing to commit. And this IDTA has, NVIDIA and Qualcomm and Cisco and a whole, Lam Research and Applied Materials and a whole bunch of corporates, in addition to financial investors, coming together and saying, how do we ensure that we have best known practices? From a startup standpoint, what are some of the regulatory challenges that exist? What are some of the capital formation, rules that the government needs to change? So the idea of IDTA was really to be a, open consortium, and by itself, it was intended to solve the ecosystem level problems. And India has done that in software very, very successfully. It was called NASSCOM. And you could argue the reason why the Indian IT services industry became as successful as it did was because of the efforts of NASSCOM. So IDTA, hopes to, be like a NASSCOM for some deep tech things. So by itself, it's a necessary thing, not sufficient. So a lot of us have to be looking at our own core strategies and seeing where do we want to play and be disciplined about it.
Thank you, Sriram. I really appreciated everything you shared today in the Corporate Venturing Insider series. And I think it will be helpful for CVCs, VCs, but also entrepreneurs listening in, knowing what questions to ask and how to prepare well. Thank you.
Thanks for having me.